Morning, everyone. Welcome to today's webinar. This is Lin Xin, your macroeconomist for Asia ex-Japan region. So now that we are halfway through 2015, today we are going to give you a broad overview on how the Asia ex-Japan region has fared so far, and some of the outlook that you might wish to take note of in when we are going into the second half of the year. So without further ado, okay. Although that we have already passed 5 months into 2015, but we have seen that global economy remains slow, and World Bank, the International Monetary Fund, even OECD have actually revised downwards their 2015 growth forecast. As for roughly for this year's global growth, it will be about 2.8% to 3.1%. So it will be roughly about an average of 3% this year. And as you can see that from this chart here, it's actually indicating a ratio of market cap to GDP, where you can see that countries with high ratios are actually due to the real economy drivers, the fundamentals of the economy is not really catching up with the capital markets. Capital markets are actually rallying on optimism and liquidity. So please do take note of these few countries, namely US, Japan, China, and as well as Indonesia. So if the real economy is not really picking up soon, then we might see red flags coming from these few countries. And as we know that US has actually pledged to raise their interest rate by this year. However, as mentioned earlier, World Bank as well as IMF have actually urged US not to raise their interest rate until next year. However, from the foreign exchange side, we have actually seen another round of taper tantrum in the emerging markets, especially those with pockets of weakness, in particular with twin deficits. For example, Indonesia and Thailand side. On the left-hand side, you will be able to see that China yuan has actually steadied, while Sing dollar as well as the India rupee has actually followed the trend of USD strengthening in a broad base. On your right hand side, you actually see that for the Indonesia rupee, Thai baht, and as well as the ringgit. So in addition to the USD strengthening, we also see that capital outflow is another forces in play. And I will elaborate further on our respective macro fundamentals later, which actually also drives the foreign exchange. So another point to take note of would be on the inflation. So we see that their tailwind of low oil prices will soon diminish as the base effects will start to wear off in the second half of the year. And El Nino effect will actually push up food inflation within the region, especially in the Southeast Asia. As you can see from this chart here, India, Indonesia, and as well as Malaysia will be facing inflationary pressure due to the dry spell from El Nino. And Malaysia in particular will be seeing a spike due to the GST implementation in April. And the cabinet has actually proposing that there will be a gas tariff hike as well as a toll charges increment by end of this year. So for other countries where we are seeing a low inflation rate, these countries actually have more room for the central banks to maneuver, for them to ease monetary policy further to boost growth. So these are the few major events that would increase market volatility in near term. And just to highlight two other headwinds, the MERS breakout, namely the Middle East respiratory syndrome, that we are currently seeing that there's an outbreak in South Korea. So up to date, there have been 15 deaths reported, and as well as 150 cases identified, one in China and the remaining is in South Korea. So this endemic disease will actually weigh on retails, airlines, and tourism-related sectors in the North Asia region. But Eurozone, due to their currency weakening, and Southeast Asia region should be able to benefit by taking up the slack. As for the El Nino, this actually clouds prospects for the Southeast Asia crops, hitting agricultural commodities from coffee to rubber. So this would actually push up raw material prices for industries. Lower supplies would also indicate that there will be lower exports for these producing countries. So moving on to respective countries' macro. As we have actually elaborated in last week's webinar, so I shall not go into details for China and Hong Kong macro, but just to highlight, as expected, MSCI did not include China A shares during their June review last week, but MSCI inclusion is inevitable, and however, we also see that the market has actually rallied and priced in the inclusion. And another point to highlight is that H shares are actually more attractive compared to the A shares in terms of fundamentals as well as valuations. India. For India case, we see India as the lone bright spot in the Asia region, being that it has quite a stable headline inflation at the moment, and as well as Reserve Bank of India has actually cut their repo rates by 25 basis points to 7.25% last week. And another good news would be that the current lending rates has actually started to be reflected in the past rate cuts. So the commercial banks have actually lowered down their lending rates, their borrowing costs, to be in line with the current benchmark interest rate. So this should be able to start kicking up the investment as well as the credit cycle. For the upcoming parliamentary session, we are hoping to see that there are significant reforms bill to be approved. In particular, this GST bill, labor laws, as well as the land acquisition bill. So GST would, we are actually optimistic that this GST bill would get through the parliament this round, and it will be on course to its debut next year. So this GST bill would replace various national and state government levies with a single national sales tax. So with this unified tax system, it would enable India to establish a single market, cutting red tapes, and as well as expand the tax base, and hence helps in fiscal revenue. As for the labor laws overhaul, this would actually relax the rigid hire and firing rules and help to create jobs. For land acquisition bill, if approved, then the infrastructure projects will be able to kickstart. However, if there are further delay in these reforms, we'll see a correction in the equity market as investor sentiment will be weighed on. And another point for India would be that the Make in India campaign would actually transform India into the new manufacturing hub, picking up China's manufacturing slack, and hence help to drive the region's growth in the next few years. With all these factors in mind, we maintain an overweight position for the India equity. Moving on to Indonesia, we see that Indonesian economy is still slow due to low commodities prices, and we have yet to see any rigid reforms in progress. As mentioned earlier, we'll be seeing that inflation would remain high due to the El Nino effect, but we are quite positive that it will start to cool down after the September. The main concern for the Indonesia economy would remain on the foreign funds outflow. So the two main contributing factor that causes a reversal of fund would be, firstly, from the external end, would be on the US interest rate hike, while from the internal factor would be due to the slowing economy, rising inflation, as well as combined with a weakening rupiah. Rupiah has actually been Asia's worst performer. It has actually hit a 70-year low. However, with the combination of weakening rupiah as well as a rising inflation, this actually limits scope for central bank to cut interest rate to maintain exchange rate stability. So in general, if Indonesia government is unable to kickstart on their infrastructure projects and stabilize the economy, we might be seeing that fund outflows might exaggerate and aggravate. Sorry. And if there's no rigid development, in particular in relation to the lack of financial resources as well as the land acquisition, we'll continue to see that the economy will continue to slow, probably towards 4.5% GDP growth this year. With all this in mind, we reduce our neutral weight on Indonesia economy to underweight. Thailand. Thailand is quite an interesting country to look into, as we are seeing that we are seeing a never-ending sequels in the Thai political drama. We have yet to see any rigid political reforms. They have yet to finalize the draft charter, although that they have pledged that they are going to hold the election next year, September. And the funny thing is that the government is actually planning to create a new National Reform Council. And this this proposal actually invites two different school of thoughts. One would be positive, as the current Reform Council is underperforming. So with a new body, we are hoping to see that probably there might be more supportive, and also we'll be seeing that reforms will be able to jumpstart and revitalize the economy. However, there also been some criticism that this move is actually for the Prime Minister General Prayuth to consolidate his power, as by forming a new body, he will be able to ensure total obedience of the members. With all this in mind, we are actually maintaining our underweight stance in Thailand's equity market. Malaysia. Malaysia, similarly to Indonesia, has been plagued by weak commodity prices. And as we know that they have actually implemented their GST they have actually implemented their GST in April. Post GST would, sorry, um, af- after implementing this GST, it actually further compress the purchasing power of the struggling Malaysians after they have cut few subsidies last year. And as mentioned earlier, that the cabinet is actually reviewing whether to increase the toll charge as well as the gas tariff by end of this year. If they are going to do so, we'll be seeing that the consumption sector, the consumption side of the economy drivers will continue to be depressed. Well, that being said, all these moves are actually positive for fiscal consolidation. And we have actually seen that ringgit has been depreciating for quite a bit in the recent weeks after the whole controversy of 1MDB, the One Malaysia Development Berhad controversy. So this program has actually chalked up about 42 billion ringgit over 6 years. And some of the creditors are actually saying that they might consider on requesting on early repayment. And if the creditors are going to do so, that might even further dampen investor sentiments. Another risk to look at would be on Fitch ratings. They are going to review on Malaysia's creditworthiness, and they will be announcing the review results by end of June. Currently, Malaysia's debt is rated A minus, and if Malaysia's rating is going to be down by one notch to BBB plus, then the financial markets, being the currency, bond as well as equity, could suffer a further hit. Having said that, both S&P as well as Moody actually have maintained a stable and a positive outlook on Malaysia's sovereign rating. So with the risk of current account narrowing and on their credit risk, we are actually maintaining our underweight on Malaysia's economy. Singapore. So for Singapore, and we have been seeing that growth have been quite bleak in the first half of the year, but we are positive that the public spending on mega infrastructures projects, for example, the Terminal 5 in Changi Airport, would be able to support the economy for the second half of the year. And on the other hand, the ongoing global recovery should be able to bode well with the external-oriented sector, in particular the manufacturing side, electronics, semiconductor side. And we're actually speculating that there might be an early election this year. Meanwhile, for the currency side, we'll be seeing that there will be a downside bias to SGD USD trend as USD strengthens on a broad basis. And we've been also seeing that Singapore is actually preparing for the interest rate hikes in US, as we can see that the Singapore government bonds yield are actually increasing in the past few months. With all this in mind, we maintain our neutral weight on Singapore. So this is just a summary on our current stance in the respective countries, as well as some of the unit trusts, as well as ETFs, which you may consider to invest into if you are positive on that particular economy. With that, I would like to end my presentation for this week's webinar. And just a side note, you might wish to take note of this Thursday's FOMC meeting results on interest rate in US. So now I would like to open the floor to any questions uh, that you have burning in your minds. There's a question on China if there will be any correction soon. So our view would be that we are seeing that the Chinese authorities have actually tried to enforce on risk management controls, and we'll be seeing more financial institutions, especially brokerage house, to implement on stricter margin lending rules. So that would actually create pockets of opportunities to enter, and also we'll be seeing that a very quick correction and recoveries in near term.
Okay, mic check. Okay, hi. This is Kenneth here. I have a question on Valuetronics. Okay, so two things. Why is the dividend, Philip report dividend different from declared dividend? Okay, the dividend that I put in is a forward dividend, is what is going to be expected for next year. That's why there's a slight difference in the dividend you see there. But more importantly, the question is Valuetronics negative trends forecasted to reverse and normalize in FY17. What's the basis? The basis of that is basically a continuation of the ICE growth and basically a normalization of the CE or consumer electronics decline. As of now, because the CE LED cycle is slowing down, so Valuetronics is in the midst of essentially trying to retool and to find different CE clients per se, and they're in the midst of that already. So we actually think that by next year, the LED decline will normalize and it will give them time to basically improve or find some CE prospects on top of their ICE continued growth based on good US macro and their niche position as someone with a competitive advantage because they're able to do the same type of services, but they're very cash rich, so they're very attractive for these mid to small size companies to actually um, commit a large part of their manufacturing to them because of their track record, stability, and high cash flow position. Thanks. There is no update per se on Valuetronics. I mean, it's the same thing. Please read the report for our projections for this year and the next year.
Uh, there's a question on to highlight on what would be the key factors or catalysts for China in the second half. So mainly we are looking at two things. One would be on more monetary policy easing as well as targeted stimulus measures. So what we have been seeing is in May is that there's a pickup in industrial production as well as manufacturing sector. So with all this, if they are going to ease monetary policy, we'll be seeing that growth and Chinese economy will be able to stabilize soon. And the second driver would be more opening up in China. We may be seeing a Shenzhen, Hong Kong stock connect by end of the year.
Okay, just one more thing about price weakness, right? Let me just say about Valuetronics. I mean, look, don't also forget the Singapore market has also had a short cycle of decline already in the first place, so there is broad market risk. I mean, is affected by broad market sentiment. But at the same time, I also want to just talk a little bit about the so-called poor resource management. Now, you might think it's poor resource management in the sense that they have a large cash balance, um, but you have to also account for the way they've always does things. they have always been conservative when it comes to maintaining cash. And there is a reason why their ICE segment has been growing by 10 to 15% for the last 2 years. One of the rationale is because they have a competitive advantage because they are able to get these mid to small size niche companies to fully, uh, fully or almost fully outsource their manufacturing to them because they have shown that they have great financial stability and great flexibility to adapt to any of their needs. That is actually a competitive advantage. And at the and following which there's going to be a certain extent of their cash position before they choose to capex harder, as well as to look for other types of investments. So now, in terms of 8 times PE, one must also see that, first of all, there are two ways of looking at it. First thing is this, why is it worth, for example, 8 times PE? First thing, if you add in all the cash, it's not even, I mean, it's not just 8 times PE, right? I mean, PE now is like, X cash is like 4 times or something like that. But more importantly, right, if you look at its peers, if you look at Valuetronics peers, you see that even with the cash position, right, they still have superior ROEs and higher than average margins. That alone, just based on peer evaluation, actually 8 times is considered to be conservative. Considering these other companies that one, they have debt, two, their margins are lower, three, their ROEs are lower, and some of them are even going for higher than 8 times PE. Who are Valuetronics peers? I believe that the last report actually has their peers in the report. Please take a look. Okay, thank you.
Hi, good morning. De Hong here. There's a question on the outlook for SG REITs, and the question also touches on whether healthcare REITs are defensive with the coming conditions for the Singapore market. Now, we have just issued a REIT sector report 2 weeks ago. Basically, we are still overweight on SG REITs, even though we acknowledge that valuations are catching up. But we would like to reiterate our stand that we recommend clients do stock picking within each sector and pick the star performance within each sector instead of applying a sector-wide recommendation. So the reasons why we are still bullish on SG REITs is fourfold actually. Firstly, rising interest rates actually, the most direct way that rising interest rates will affect REITs is higher borrowing costs. But we see that after the financial crisis, a lot of REITs, they actually have adopted very prudent balance sheets. So for now, a lot of REITs actually have about more than 80-90% of their debts hedged, and they have very well spread out debt refinancing. So in that, even if interest rates go up, you wouldn't see a huge spike in interest in financing costs in a single year because they have very well spread out debt refinancing. So that's number one. Number two is that if you look across the S REITs as a whole, you see that the sector yield versus the risk-free rate, they actually offer a spread, a premium, a spread of more than 3%, and this spread is actually more than what our US counterparts or the Japanese REITs are offering. So we see more value in the REIT sector in that sense as well. And thirdly, even though we know that rising interest rates are likely to go up at the end of this year or early next year, we think that Janet Yellen would more likely err on the side of caution in that what the Fed has been trying to do in this past few years in keeping interest rates so low is that they're trying to kickstart the economy. So at this current moment, we think that Janet Yellen would actually not run the risk of derailing the recovering economy and rather be faulted on rising interest rates too slowly rather than derailing the recovery by rising interest rates too quickly. And indeed, they have also mentioned before that even if interest rates were to go up, the pace of the going up, the pace of the rising of the interest rates is likely to be a slow one and not a rapid rise. So we see the current correction in the REITs index as more of a knee-jerk reaction in the strong jobs report that we saw a few weeks ago. So lastly, in our model inputs for all the REITs that we have modeled for and achieving the target price, we have actually factored in a risk-free rate of 3.1%, and this 3.1% is actually a very prudent and very safe input because right now we see that the 10-year Singapore bond yield, which we use as a proxy for the risk-free rate, it has gone up in the last 2 weeks from about 2.3, 2.4 to a current about 2.6 or 7. And that is the cause of the downward correction in the REITs index as well. So currently we are seeing 2.6 or 7, and our input is about 3.1. So with that input, we feel that we have already more or less more than factored in the rise in the interest rates in our modeling. So the next part of the question about whether healthcare sector is the defensive sector with the coming conditions for the Singapore market. As we've mentioned, no doubt healthcare is the most defensive sector if you consider the conditions and the drivers behind it. But we would like to say that even within, we wouldn't like to consider sectors as a whole, but we see that even if you look at, like, let's say, the retail sector, you deem the retail sector to be more susceptible to changes in the economy, but we still see this defensive plays within the retail sector, like Fraser Centrepoint, because of their resilient portfolio of suburban malls. As for the healthcare sector, we think that the drivers going forward, okay, we want to highlight two REITs in the healthcare sector, the Parkway Life REIT and First REIT, which we are bullish on. So both of them have this model, revenue reversion model, which are pegged to the Singapore CPI. But the Singapore CPI has been weak thus far. So growth this year for both these REITs may be weak, but we think that First REIT actually has a very strong pipeline of acquisition targets coming up, and it is actually banking on the rollout of the hospital network plans in Indonesia. So that's actually a different growth driver there compared to P Life REIT, because P Life REIT, a large part of their portfolio is in Singapore. So you depend on the CPI for rental reversions. If the CPI is not good, you depend on the percentage of revenue model. But even within the percentage of revenue model, we are not very optimistic because of the weakening rupiah, and we think that that may actually affect medical tourism receipts in Singapore. Hi, Hong here again. There's a question about, I think there may be some confusion about P Live REIT, First REIT, and then just now I was talking about the weakening rupiah. So I was talking about the weakening rupiah because of P Live REIT, because I was talking about the rental reversion models for P Live REIT's Singapore portfolio. So their portfolio of the private hospitals in Singapore follow two different directions. You either take the CPI model, which is pegged to the Singapore CPI, or you take a percentage of revenue. So the higher of either one will be the rental reversion model for P Live REIT for that particular year. So for instance, if you have weak CPI numbers, for that year, if you take percentage of revenue, and that model actually gives you a higher reversion, so P Live will then take that model for that year. So my point about the weakening rupiah is that you look at this year CPI numbers are weak. So it is very possible that P Live may have to revert to the percentage of revenue model. So just for your information, for P Live, right, other than the first year after IPO, every single year the rental reversions have been driven by CPI. So this year, if CPI is not going to be the kicker, if you depend on the percentage of revenue, my point about the weakening rupiah is that a lot of receipts for our medical tourism is actually from the Indonesian group. So, and Indonesians are our biggest tourist group by nationality as well. So with the weakening rupiah, we think that that might actually affect, that could affect demand for medical tourism in Singapore, and that actually can be suspect whether it will be a strong kicker for P Live REIT's rental reversion this year as well. Hi, Tahong again. There's a question on REITs consolidation. Um, we don't think that is like a likely scenario in the current situation because this kind of instances only happen in cases where you see a lot of highly undervalued REITs or REITs trading at a huge discount to their book value. But in current market conditions, even after the discount in the recent 2 weeks, we see that even the steepest discount you can find to any REIT is probably around 20% or like point in a 10 plus 20% region discount. So the rest are all trading very close to book value. So in such a case, we actually do not see a major conducive condition for REITs consolidation.
Okay, hi. I have a question on SIFMEG. Let's see, where's the question? Question, do you expect SIFMEG to rebound to the previous levels of 64 cents? Here's the thing, right? I mean, if you just saw my report, which was, last quarter, 19th of March, my thesis is actually there, in which I already said that the fair price was about 48 cents. The price of where it is now is around those levels, 40 something cents. So, I mean, the thesis is that, yes, the sell-off has been due to a large seller uh, with a significant position, and that was a one-off thing, I agree. But at the same time, as we focus on the fundamentals of the company, right, we just think based on market condition and being a bit conservative, because they are any growth will likely occur not even 1 year from now, but a year after, as they try to execute their acquisition plans or expansion plans. So because of growth which is not this year and next year, right? We think that 8 times forward PE is fair for that. And if you use 8 times forward PE, then that basically leads to a target price of about 47.5 cents. Okay, so any improvement from this, I mean, in order to improve our target price, we would have to see signs that the acquisition is going smoother than possible, faster than maybe faster than expected, or they make an acquisition in which we feel that their investment price is attractively priced, and there is earnings increment, then maybe we'll increase our target price. So at the moment, we think a fair price should be roughly 47-48 cents. Okay, with that, we'll close today's webinar. Thank you for tuning in, and we'll see you again next week. Okay, bye-bye.